So when to refinance? Let's talk about a very simple explanation. Simply compare the total cost of your old loan versus your new loan. So take the total cost of your old loan, and we'll show you an easy way to calculate that. Subtract the total cost of your new loan, and that'll give you your total savings. Now there may be circumstances that you find yourself in that warrant refinancing, even if the overall cost is higher. The purpose of this video is to help you make a good decision. Keep in mind that banks earn about 25% of their profit for the first 5 years of a 30-year loan. So don't get caught up in the hype. You may see examples of lower your payments or lower your interest rate or even save hundreds of dollars every month. Once you have a loan for about 5 years, you can expect to see marketing from banks because they know that they can earn much more money in the first 5 years of your loan. So let's take an example of a loan at $250,000 at a 5.75% interest rate and $1,458.93 a month for the monthly payment. So 5 years later, you have a balance of $231,905. So let's say you were offered a new loan at $265,000 because you wanted to take $30,000 cash out. They offered you a 4% interest rate, and they offered you a monthly payment of $1,265.15. Now this may look really good. You'll lower your payments by $193. You'll lower your interest rate by 1.75%, and you'll get more than $30,000 cash out. So if it looks too good to be true, it may just be too good to be true. Front loading is what the banks use to make more of their profit in the beginning of a loan. 79% of your payments in the first 5 years in this example will go directly to interest payments toward the bank. You would have already paid more than $69,000 in interest to the bank in the first 5 years of this example. So now let's compare the old loan. Your payment, $1,458.93 a month. You have 25 years left, 12 months and a year, and when you multiply that out, the total cost of that loan, $437,680. Now let's look at the cost of your new loan. You have a new payment of $1,265.15. You have 30 years to pay it off in 12 months. Let's add $2,650 for closing costs. That's just 1%. And you have a grand total of $458,104. Now that's an additional $23,705 so that you could borrow an extra $30,000 cash out. However, let's take a look at this in a different situation. Let's say that you chose to do the refinance, but you also had the ability to keep making the original payment. So if you chose to do that, you would save an additional $35,616 in interest. Your payoff date would be much closer to your original date, so instead of 5 extra years, you'd only have an extra 8 months. And if you chose to pay an extra $42 a month, you could actually have the same payoff date and save $41,877 in interest on this new loan that you chose to do. Now we understand that it may be difficult to calculate all these numbers by yourself. And so as part of your ebook, we've also included your mortgage dashboard. Now this is just a simple Excel spreadsheet that has many amortization tables in it that will help you understand how your loan works and enable you to look at different examples and different scenarios so that you can see what happens if you make different decisions. We also give you the ability through the My Mortgage Dashboard to track your payments, and we'll talk more about the mortgage dashboard later.